Using a combination of valuation methods, we arrived at a price of 1368, which is around 20% upside from its closing price as of 25th November 2016. We will depict how PVR is very well positioned to take advantages of the opportunities in the industry and is supported by strong financials and valuation, which gives a strong buy recommendation for the company. We first look at some of the macroeconomic indicators which affect the industry. India's demography is in its prime, with around 65% of the population in the age group of 15 to 64. Apart from being the primary work group, this group also signifies increased consumption and discretionary expenditure. India's GDP per capita has been growing at a CAGR of over 5% for the last 10 years. Both these factors are set to increase the discretionary spending in the economy, which will impact the exhibition industry positively. The exhibition industry currently is characterized by three important factors: increased multiplex penetration, consolidation, and replacement growth. We talk about each of them in detail. Though India is the largest movie producer in the world, it is grossly underpenetrated with only 7 screens per million population. This is highlighted by the low multiplex penetration in Tier 2 and especially Tier 3 cities. This provides a room of expansion for the multiplexes. If this expansion is undertaken, this will benefit the industry by improving the ROIs as digitization is high in the multiplex space in India. The multiplex space has been growing through inorganic means majorly till now, but the future lies in organic expansion as the industry has become much more consolidated. Around 70% of the total multiplexes in the country are controlled by the top 4 players, and these top 4 players also have ambitious expansion plans. This provides them with huge bargaining power when dealing with the distributors and will allow them to negotiate a higher share of the net ticket sales. The most important feature of this industry right now is the declining number of single screens. With an already underpenetrated market, the declining number of single screens provides a huge opportunity for the multiplexes to capitalize on.
PVR is the leading multiplex operator in the country and it is well positioned to capitalize on the growth opportunities in the sector. The company is strategically expanding its footprint because of the strong geographical presence and well execution capabilities. It has the highest market share in North and West with about 50% and 43% respectively. Last week, it also became the leading multiplex operator in Gujarat, maintaining its dominance in the West. The regional cinema industry is witnessing huge investment opportunities, and as was mentioned in the con call, PVR is expanding its presence in the south due to the underpenetrated nature of the market and because the occupancies are as high as 50%. Scale is crucial for this business, and PVR has the highest screen count amongst all the other multiplex operators. It is present in the major cities with about 63% of its properties in top 4 cities and 84% of its properties in top 15 cities. These cities have higher ATPs as compared to the other cities. The ancillary businesses are leading the show for PVR. It was the first to introduce the dynamic pricing for its F&B business. The F&B spend per head is growing at a 12% CAGR from fiscal year 11 to fiscal year 16. Also, it has been able to do this by expanding the F&B menu from basic meals to the combo option. It was the first to make the in-cinema advertising a national forum. It has been able to garner about 35% market share in the 6 billion in-cinema advertising market. It has been able to do this by capturing the high-quality catchment areas. PVR has also maintained healthy key operating metrics with high ATP and high occupancy. The maturity of the PVR screen has risen from 50% in fiscal year 11 to 69% in fiscal year 16, and as the maturity of its screen rises, the occupancy level rises. Also, it has maintained a high occupancy because of the enhanced customer experience that it provides. Last week, it signed up with the South Korea CJ's Corporation to add 1048 screens in the country. PVR has maintained healthy premium pricing over the industry because of the strong brand equity that it has. It has a wide range of brands from PVR Premier, PVR Talkies to PVR Gold Class. It is also the anchor tenant for more than 50% of the top 20 malls in the country. All these factors point that PVR is well positioned to capitalize on the growth opportunities in the sector.
PVR is riding high on robust financials. The company is achieving stability and growth on account of strong fundamentals. The business is well supported by the box office and the non-box office revenues, which are expected to grow at a CAGR of 16.2 and 21.7 respectively. Also, with the inclusion of the new in-house brands for the foods and beverages, the margins are expected to rise further. With demonetization picture, we have taken into account a small dip in the overall occupancy levels for FY17. The same is expected to grow to 35% by FY21. The team expects the net profit margin to remain constant in line with last year at 6% for FY17, and it is expected to grow to 30% by FY21. The debt profile of the company is also improving, lowering debt to equity ratio. The high interest coverage ratio also suggests the strong growth in EBIT over the years. PVR has been able to exhibit a strong cash generation ability, because of which it has been able to fund its organic expansions through the cash generated from its own operations. Also, the healthy cash flows are evident from the high CFO to capex ratio in FY16. PVR also exhibited a high return on equity in FY16. The main drivers for the same were the equity multiplier and the net profit margin. The team forecasts the return on equity to rise further in the upcoming period.
We use a combination of discounted cash flow and relative valuation for valuing PVR. With DCF, we arrived at a value of 1349 using a two-stage growth model. With relative valuation, we use the PE multiple and the EV by EBITDA multiple for valuation of PVR. We chose two competitors, one Indian, that is Inox Leisure, and one Chinese, that is Wanda Cinemas. Using a 70% weight on DCF and 15% each on EV by EBITDA and PE, we arrive at the final target price of PVR, that is 1368 rupees. We also plotted PVR on the 5-year PE band chart, and where we found that PVR is currently trading below the 7-day forward PE, which shows a room for improvement in the prices and value to be unlocked for the investors.
Coming to the risk part, we have identified key risks and mapped them on the basis of their impact and likelihood. The first risk we have is the content risk. Content and flow of releases is of prime importance to the exhibition industry. Poor content and delayed releases reduces the occupancy level, which directly impacts the PAT numbers. As you can see, change in occupancy levels from current 34.6% to 29% will change the recommendation from buy to sell. The content risk was quite evident in financial year 2015 and the quarter 2 of this year as well. To mitigate this, PVR is trying to improve its content mix by increasing the number of Hollywood and regional movies. Second risk we have is the inorganic growth risk. Inorganic growth has been part of PVR strategies over the years. However, because of consolidation in the industry and PVR's plans to not acquire single screen, the scope of this approach is limited. As you can see from the stress, number of screen additions over the next 5 years, if reduced from 251 to 180, will change the recommendation from buy to sell. To counter this, there is a growing trend of retrofitting of single screens to multiplexes in the industry. Third risk we have is the infrastructure risk. PVR looks for upmarket location for its theatres. Slow development of malls, real estate locations will hinder this. These delays may even get extended because of demonetization. Along with that, as you may see, across all major cities, malls have been underperforming. Underperforming of malls are leading to reduced footfalls, which directly channelize into low occupancy levels in theatres. Stress test for occupancy levels holds here as well. To counter this very important issue, PVR is trying to maintain its brand value. If PVR maintains its brand value, it will be the preferred choice for mall developers in the future as well. Fourth important risk we have is the corporate governance risk. SEBI issued a show cause notice to PVR regarding a profit sharing agreement between promoter Mr. Ajay Bijli and the private equity investors. The response is still pending from PVR side. However, corporate governance is a very sensitive issue. But in this case, when the agreement was signed, it was well within the SEBI laws. So, if in future any corporate governance issue pops up, this will be an area of concern. So finally, based on our research and recommendation, we reiterate a buy recommendation with an upside potential of 19.81%. Thank you. We are now open for questions.
You guys know at what valuation currently the stock is trading at? Don't you think it's very high compared to the market, and your focus in the presentation should have been to address the valuation premium that it currently has, and why even at this price you should go ahead and buy the stock? Don't you think that should have been the core of the presentation? Any one of you can answer.
So the entire presentation, what the team believes is that there is still potential for value to be unlocked for the investors, and that is the reason why PVR, though trading at a premium than its competitors, but still it is justified, the valuation are justified, and we still see a price increase over the years, over the next year. Now, if you also look at the multiples that it is trading, so though it is trading at a multiple of maybe 55, as of now, P multiple of 55, what we believe is Inox, when we compared it with Inox, PVRs, due to the enhanced customer experience and the good offerings that it has, it ideally has to trade at a premium as well. And the entertainment story is just starting to unfold in India, and that is the reason why we believe PVR valuation at 1368 is justified.
Ask one more question. This one on the industry, you mentioned that there is a large section of 15 to 64 age group, which is a potential group. Is just age a factor in terms of watching movie, or is there anything else that you need to look at within that age group?
The age group that we mentioned, 15 to 64, is considered the working age. Now, this age group we refer to because this will signify the discretionary spending that the consumer class will have. Obviously, people beyond 64 and below 15 also watch movies, but then the dependency on the 15 to 64 age group will actually fund that expense, because the discretionary spending actually comes from there, and as the GDP per capita rises, the age.
My point was, within that age group, there is a section which can't afford to go to the multiplex at this point in time. So that's not the target audience, right? So your analysis ideally should have been only those people within that age group who can afford to go to multiplex, which means tier 2, tier 3, may not be even tier 3, tier 1, tier 2, that's it.
So, definitely the affordability is a factor, because the entire population will not be able to go to the multiplexes. But then this will directly, this is not directly, we are not saying the 100% of the population in this group will be watching movies. What we are trying to say is, since the income level of this population will be increasing, so whatever percentage of the people are watching movies in this group will actually improve, because they will be able to spend more. So maybe the people who are not being able to spend and are not watching multiplexes right now, if their discretionary spending increases, they will also come into the fold and they will also be able to watch movies.
Sir, adding to this point as well, when we look at the entertainment options available for people in India, so multiplexes are one of the best entertainment options available, wherein say you go in on a Saturday or Sunday, spend 1 or 2 hours in the mall, maybe window shopping or shopping, and then you enter into a multiplex, watch a movie and then come back. The lack of other entertainment options also puts PVR in a better position to capture the market.
So in one of your slides, you mentioned that digitization is, going to aid profitability of the business. Why do you think so?
So, as we mentioned, the single screens are declining and the multiplexes are increasing. And as the digitization comes in, the cost for showing a movie comes down. So, with the replacement growth, the overall cost for the industry will come down.
Sir, And adding to this point as well, when we look at digitization, so there has been a phase of digitization which has already happened. Now, when we look at the experiences that PVR is creating, it would be moving to laser format as well, and then adding maybe 64 speakers in the movie hall, and all these experiences will be putting PVR in the premium position. When we talk about 4DX as well, which has been added, IMAX, and all these experiences will put PVR in the foremost position.
Second thing you mentioned, one more thing in the slide is that PVR has the scale, and scale is very, very important in this business. Why do you think scale is important in this business?
So scale is important in this business because as we already mentioned, the industry is under-penetrated. So India is a movie-loving country with around almost 2,000 movies produced, which is with the majority being regional movies. So as PVR has a scale and is already expanding into the uncharted territory, so it will be able to cater to those movie-loving public ahead of its competitors. So the scale becomes actually very important because people want to get the movies, see the movies, and if they get the experience of PVR, the customer experience that they get, they will be able to actually get higher revenues.
So one more point is that people don't go very far away from their place to watch movies. So screen should be at all the places and strategically located so as to occupancy levels that PVR expects to go forward with are maintained.
Just one last from my side is, you also mentioned that content, creates disruption as far as the occupancy is concerned. So it's there's a lot of cyclicality in the business in terms of, and that cyclicality is driven largely by content which is not under your control. I'm saying the control of the company. So there is some cyclicality in the business. So don't you think that this cyclical nature of the business should depress the PE rather than giving it a premium over the market? Second thing, you were comparing it with Inox, which is the only competition. So maybe that's not the right benchmark, but I'm saying the inherent cyclical nature of the business, don't you think it should compress the PE?
So yes, content is a very big issue in the exhibition industry. Worldwide, if we see box office collections, the percentage of total revenues is around 50%. For India, it is a little higher rate. But across Indian competitors, PVR is best placed with around 60% of its box office revenues, collections from box office, and it is trying to improve its revenue mix by increasing the ancillary share. So it is trying to reduce the dependence on content mix.
Also, sir, as we mentioned that the major share of the movies that are made in India are regional in content. So as PVR expands into the entire country, so it won't happen. It is very unlikely to happen. Rather that all the regional movies and the national Bollywood also have a bad year at the same time. So we expect that some regional movies will actually take place, will compensate for the bad content of the other movies. But we already said this is a risk for the company.
And in line with that, they are trying to acquire more business from the Hollywood business as well, so that they are the largest distributor of the Hollywood movies in the country. So as to kind of negate the effect, the cyclicity effect which is there because of the Bollywood.
As PVR is tier 2 and tier 3 cities, its financial leverage is likely to be under pressure, and it's already a movies business is kind of it has high operating leverage, cyclical business. Will you not add more risk, as the expansion goes forward?
So the PVR as a strategy, PVR has been growing its organic business as we showed by cash generated from its own business. So the financial leverage risk is actually reducing because of that. For the point of operating leverage that we're talking about, that will stay because PVR actually operates on an operating lease model and has all the buildings and then on the operating leases which shows as the rent out there. So which is a fixed component. So there the depreciation charge it does not have to take care of. So from the operating leverage and the financial leverage point of view, the company is very stable going forward.
And do you think in tier 2, tier 3 cities,